Is the Fed about to start buying gold? I mean, they've tried almost everything to stabilize the markets, and there's only a few options left. In this video, we're going to look at what options are left and why it's in the best interest of the US government for the price of gold to be rising. So stay tuned. All right, welcome back. If you're new to the channel, my name is Mark Moss. We like to talk about making money. We talk about investing money. We talk about having overall success. I like to talk about it through all different types of markets, fundamentals, asset classes. If you like to hear about those types of topics where I take very complex financial subjects and break them down in easy to understand and most importantly, actionable information, then click the like button right now. Make sure you hit the subscribe button so you're notified every time I put new videos out. All right, now today, like I said, we are talking about gold. We're talking about the Fed. We're talking about what they're doing to try to save the markets. And, I've done several videos on this leading up to this, and we've been talking about all the different tricks, if you want to call them that, schemes, scams, whatever the Fed has left to try to save the economy. Now, in my opinion, they should just let the market be the market, but they're constantly trying to meddle, trying to manage. And so they're doing all these tricks and schemes and scams and so forth. Now, like I said, we've been discussing all these different tools that they have, and we talked about how they affect the markets in different ways, all right? But we all know one thing, and that is, well, we've all learned one thing anyway, and that's don't fight the Fed, right? I mean, they have way too much money. And so, if they're printing trillions of dollars and they're buying stocks, as we've just seen, the stock market's going to go up, right? And so what we should do, if you can't beat them, you join them, right? If you can't bet against them, then bet with them. And so if they're going to pump money into stocks, then we should probably buy stocks. That's what it's looked like. And that has become the investing thesis of so many people today, right? It's called the Fed put, which is basically betting alongside the Fed. The Fed's going to continue to push prices. All this new breed, all these new traders that have come out, led by Portnoy and Robinhood and whatever, they're all basically just saying bet with the Fed. It always goes up. The Fed will always drive it up, right? But they have tools to do this. They've already deployed almost all the tools. I made a video recently and I said they only had one tool left, but really they got two. And we're going to talk about that. Now, we're going to talk about why the Fed may buy gold, why that's an option for them. And we have to understand that, like I said, the Fed has many challenges, right? And they have a lot of challenges, but they don't have enough solutions, at least not enough solutions that are left undeployed. And so they're kind of stuck, right? We have this crashing economy. The economy is ground to a halt. The markets crashed as well, and so they started printing trillions of dollars and injecting it into the markets, injecting liquidity, buying bonds, buying debt, propping up asset prices, etc. And so they're making these large-scale asset purchases to try to keep the values propped up, and also to keep the credit available, keep the credit cheap, right? So now basically they're just piling more debt onto bad companies, onto bad assets, and so if the interest rates go up, how can they afford it? They can't, right? So they have to not only keep it available, but they have to keep it cheap. And because of, like I said, the more and more debt they're getting, we have the government now with multi-trillion-dollar budget deficits. And like I said, there's only a couple options left. And we're going to talk about that. Now, I'm going to make the case that I think maybe they may be forced to buy gold. And I'm going to explain each of the options so you can understand what they are and why gold might be the last option. Now, this is really specifically for the U.S. because the U.S. is still the reserve currency of the world. And if the U.S. wants to maintain its power as the world's reserve currency, then they have to maintain an appearance of responsibility for being the world's reserve currency, right? They can't just print endlessly and have all these deficits. I mean, people will start to lose confidence. Now, this isn't the first time this type of talk has come. I'm not the very first person to bring this up, obviously. Back in 2016, PIMCO's strategist, Harley Bassman, he suggested that instead of buying bonds or stocks or crude oil, quote, the Fed should unleash a massive Fed gold purchase program that could echo a Depression-era effort that effectively boosted the U.S. economy, end quote. Now, at that time, Bassman said, quote, again, quote, the Fed should emulate a past success by making a public offer to purchase a significant large quantity of gold bullion at a substantially greater price than today's free market level, perhaps $5,000 an ounce. It would be operationally simple as holders could transact directly. And the fact is, as you can see on the screen right here, since 2018, the dollar's been losing value against gold, right? While maintaining what looks like stability if you compare it to other currencies. And so I made a video recently about real estate. People didn't like that one. And I talked about relative. You have to look at things relative to other things. And I talked about real estate, how maybe it was expensive dollar-wise, but relative to the monthly payment, it wasn't. And so gold and dollars are the same way. So when you look at dollars compared to other fiat currencies, it looks relatively stable. But when you look at dollars relative to something else like gold, it looks completely different, right? And so the dollar has been losing value to gold. And now the Fed's been facing these challenges now for about a dozen years. I mean, things were starting to get good. They tried to normalize and boom, threw us right back into this situation. And it's only been exaggerated because of the pandemic, right? Now the economy was forced to shut down. And what's going to happen is that is going to cause more problems in the months and years ahead. I mean, we know that economic output is going to remain low. It's going to remain well below what the potential is for years to come because of the pandemic, because of the effects, because of how long it's going to take things to, I don't want to say even get back to normal, but get back to whatever a new normal, whatever a new stabilized level is. Like I said, it could take years at least to get there. And this has basically led to the government having to print trillions and trillions of dollars and inject it right into the system, as well as creating U.S. federal government budget deficits. So the government doesn't have enough money, not enough revenue coming in. They have to spend even more money. That's the deficit. That's how much money they're over. Now that amount has exceeded over $3 trillion just this year alone. And I think it's just the beginning. Right? We know that, and there's plenty of reasons why, and we can talk about those in other videos, but $3 trillion just this year, and it's only the beginning. It's going to get so much larger. And with all this debt accumulating, the interest rates have to be kept at zero. When you're talking 23, 25, 28, $30 trillion, even a fraction of an interest rate point makes a huge difference. And so rates have to be kept at zero and potentially even going to negative territory, which we're going to talk about. Now, we've already seen that happening in lots of other countries around the world. I think 6 central banks already have negative rates. And so the bottom line is that the Fed cannot allow interest rates to start to rise, which was part going back to that real estate video. Relative, the prices are cheap because interest rates are low, and the Fed can't allow rates to rise. All right, so if they can't allow rates to rise, what options or tools do they have to keep them suppressed? So that's what we're going to take a look at. All right, now option number 1 is forward guidance. All right, now this would be the first and most likely option. Basically what it is the Fed is saying that it doesn't expect rates to rise for a period of time into the future. Forward guidance. So they're basically projecting into the future that rates aren't going to rise. Okay. The problem is that rates are already low, right? They're pretty much already at zero, and the market's already priced that in. So the Fed's not really going to get a lot of bang out of this. They would really have to shock the market to get any movement out of this. And basically what they would do is they would extend the forward guidance well out past like the typical range. So they'd say, past 5 years, we're going to keep rates at zero or something like that. And then they would say that for 5 years, we're not going to allow rates to rise unless we see like our inflation target being met. All right, so that's option number 1, and we're already starting to see that. The second option is formal, and I say formal QE. Now, QE, quantitative easing, we already have that, but we don't have it in a formal way. Now, quantitative easing is basically the Fed, the Federal Reserve, buying debt of the government, okay? So basically they're loaning money, buying debt to the Treasury, the government. Now, if the government had to go to open markets like it used to, other countries would invest into it, China would buy our debt, etc. If they had to go to open markets for loans, they would demand a much higher interest rate. Nobody wants to loan at zero, right? Give me a return for my investment, right? And so if they had to go to the open market, the rates would be higher, so they don't go to the open market. The Fed just gives them the money, and they can artificially keep the rate at basically whatever they want. Now, again, I say formally because currently we are doing QE. We've been doing QE for a while, but the Fed's purchases are kind of determined every single week. In a formal program, this would all just be basically set into place. And to get an idea of how big this would be, currently, the Fed is purchasing $6 billion per day to $125 billion a month. But that's not even enough. Currently, the Treasury needs almost $200 billion per month. Now, most analysts that I've seen that I kind of agree with think that it's going to take about $2 trillion in asset purchases per year to continue to fund the Treasury. That's how short they are, $2 trillion a year. Now, if the Fed starts buying large-scale asset purchases like bonds, eventually stocks, like I talked about in one of those recent videos, then they're going to need even more help to keep the problem down. All right. The problem, though, is committing to the zero interest rates through like a forward guidance. Then what happens is it starts to raise the expectation of inflation, causing long-term rates to rise. But back to the real estate video I did, the sensitivity of the mortgage market to interest rates and also the importance that the housing sector is for the overall economy, it means the Fed they can't let long-term rates rise. They can't let that happen. So if they announce a more formal QE program, the Fed would be basically letting the markets know that they're prepared to absorb all the supply that's driven by the federal deficits. Right? So they're signaling, pay attention to that. So they're increasing the money supply, but they're saying we're going to keep the rates low to support normal economic growth. All right, now the third option, the first two, they're in place, they're happening. The third option is what we're seeing, and I think we're going to see this soon, and basically it's yield curve control. All right, and so basically they're extending the guidance, they're doing the formal QE program, those are already being put into place. But then the yield curve control basically comes in. I think we'll probably see that by September, October of this year before the election for sure. And basically it's just what it sounds like. The central banks wouldn't allow interest rates to rise above a certain level, right? Whatever they set. So it's kind of like forward guidance, but they're fixing the yield curve. So for example, the Fed would announce a rate, say 50 basis points, and then they would defend that by buying all the Treasury bonds that trade above that level. So they would allow other people to buy the Treasuries. However, if they traded above that 50 basis points, then they would just buy them all up. They'd control the market. Now, this isn't something new. This is being done. I talk a lot about Japan because Japan's ahead of us. Japan's 25 years ahead of us. And of course, in Japan, the federal government's already doing that. They're already doing yield curve control. We also did it here in the US back in the 40s to help finance the war. Now, it's never proven to deliver as much stimulus as like outright QE, as outright just buying it, but it has been used before, and it would effectively limit the rise in long-term rates, which is what they're trying to do. All right, now the next two options I'm going to kind of skip through because I've talked about these extensively. So the next option would be negative interest rates. Of course, I've talked about that many times. Basically, when you loan money, you expect to get your money back plus interest. Negative interest rates is what it sounds like. I loan you money and I pay you to borrow my money. It's absurd, right? So most likely we'll probably see that happen in the US. The next option that I'm going to kind of skip through is equity and stock purchases. Now I made a recent video where I explained that the Fed is already buying everything except stocks. And I said that I think that stocks, they'll start buying stocks probably before the end of the year when the market dips. And the reason why is that equities and credit spreads, they're very correlated, highly correlated. And if the Fed needs to tame a severe credit crisis, it's going to have to find a way to prop up the stock market. And therefore, it can maintain access to capital in a market other than the bond market. All right, so that's why they're going to do that. Now, like I said, that's a lot of options. But as you can see, the first two are already kind of in place. The third one, the yield curve control, I think we're going to see that pretty soon. Negative interest rates, we're pretty much at zero. Negative is pretty much there. And then I already said I think we'll see the stock purchasing by the end of the year. So it's kind of all the options, right? We've kind of gone through them all. At least by the end of the year, I think they're all going to be in place. So then what else can they do? And that brings us right back to the point of the video, which is the Fed could be buying gold. Now, central banks around the world, including the Fed, they hold almost 35,000 tons of gold reserves. Now, why? Why do central banks own gold? Well, they own gold to reinforce their reserves. All right, so they want a percentage of their reserves, whatever they're holding, to be in gold, and they want to do it with an asset that becomes increasingly valuable in a severe crisis like gold. All right, now the U.S. dollar currently, and it is and it has been the world's reserve currency. Now, as you can see on the screen, however, it's been slowly losing market share. And with the Fed basically going all in on financing the government deficits, the US dollar could be at an even greater risk of losing its status as the dominant global reserve currency. Now, investing in gold could really help offset this trend. The accumulation of gold as a reserve asset historically has been seen as a responsible policy response in periods of crisis. This may very well become the policy option of choice in the future. I mean, think about it. Like a decade ago, talking about quantitative easing or like yield curve control would have seemed completely crazy, right? You would have think that was the stupidest thing ever. But today, they've become not just acceptable, but the new normal, right? They're now permanent tools of the Federal Reserve. If you fast forward a decade back to today, and I think that we may be shocked at what is considered sound central bank policy anymore. Now, I know many people are going to think this gold idea is absurd, and I get it, but they might say, why not just buy oil? Why gold? Why not buy houses? Why not some other type of hard asset, right? And the reason why is because only gold qualifies as money. All right. Remember, just a few years ago, people thought negative interest rates would never happen. But today, 6 central banks in the world are already doing it. And there's basically no evidence that it's even effective. Okay. Now, while I can't be sure whether the US government is actually going to start buying gold, unless it's the last resort, like I'm making the case for here, I do think it highlights an important big picture point on gold. And that is, for the first time in a long time, it's actually in the interest of the US government for the price of gold to rise. And I think it's for 2 reasons. First, because it's going to signal the inflation the US government and the Fed really, really want. They need it to inflate away their debt. And then number 2, in the power competition that we have with China, maybe a little bit with Russia, gold can be used as a weapon against the US and the US dollar. So whoever has the most implied gold collateral of their debt is going to have an advantage. And so we want to make sure, protect ourselves from that. And so we need to have gold. And while a gold purchase program sounds like a fairy tale for many, remember, it has happened. It's happened before in the US. And it actually happened with a confirmed positive effect. Think back to the Great Depression. They bought back all the gold. They made it mandatory to turn in the gold, but effectively they bought it back and it worked. So let me know what you think. Do you think the United States government, the Federal Reserve, will resort to this as a last resort and buy gold? Do you think we will see this happen? Leave me a comment. Let me know yes or let me know no. Either way, give me a thumbs up on this video if you like the video. If you don't like the video, give me a thumbs down. That's okay. Either way, just like I said, leave me a comment down below. I love to have conversations with every single one of you. And that's it. To your success. I'm out.